All right, good morning, everybody. It is exactly 6:30 a.m. on Wall Street on CPI day. Yeah, 3 hours before the market opens for trading. It's time to get your global macro. Let's get going with Quant-in-a-Box Live, the best fundamental investment opportunities across global markets. S&P 500, yep. FTSE, Dow, DAX, yep. Gold, oil, yep. Commodities, currencies, everything. Our AI-driven analysis of sentiment, inflation, employment, GDP, technical trends, open trade positioning, seasonality, and much more. Help you uncover those opportunities. My name is Wayne McDonald. I am a properly trained economist. I love macroeconomics. I also have a master's degree in financial management, both from a little school called Harvard. What does this mean? Well, first of all, I like economics. I actually like it. It's the study of scarcity, and therefore, it's actually a social study. How do people adjust when they're trying to get the things they need to get? Very, very cool. What does that end up showing you? Well, the flow of capital around the world. And that's what Quant-in-a-Box is automating. Our AI goes into a whole bunch of different databases like the Fed, the Federal Reserve, for example, and other databases that we have to pay money for. And we pull the data out and then automate your fundamental research. So, for example, this is what our commitment of traders report looks like. And we get the data from the Commodities Futures Trading Commission, aka .gov. Cool. And it automates, like, for example, you can do your own research, and we have CPI today. Well, what does it look like compared to CPI around the world? Awesome question. So, anyways, Quant-in-a-Box is you can test it for $8. So if you're on YouTube watching the delayed version of this video, hey, why don't you kick down and come clean? Don't be a holdout machine. Is $8 worth knowing when to let your winners run? Is your confidence in knowing why you're trading and your ability to let your winners run, is that worth $8? I'd hope so. So, anyways, look at all the pretty colors. You know you want it. Organize your trading like an institutional investor would. Quantbox.co. Well, for everybody else, they're already subscribers. We're all here, 6:30 in the morning. So let's get on with it. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Let's click in and log into the Google Cloud. I'll expand the charts a bit. Boop, 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 boop. Loading. I'll expand it while we wait. All right, so welcome. Bitcoin up 1%. Holy smokes. Euro down 0.25%. S&P 500 down 0.5%. Gold down. Remember, gold futures were at 1950 recently. Now they're 1925 to 1930. Ooh. Oil's up more. Holy smoke. So if you remember, technically, we were caught on the M4. Now we're even above the R2. Holy smokes. And that's going to impact today's CPI number, isn't it? Oh, for sure. Yields are too high today, but you know what? This will probably change after CPI. One of the things you might want to watch is the Fed Watch tool. See how institutional investors are negotiating future interest rates. So we want to see if they're going to add to the November. So anywho, look at all the pretty colors. Oil is very, very bullish, and then, of course, is way up. Now, if we look at the scatter plot, so let me jump ahead here. Let me just jump ahead. Scatter plot looks like when you analyze, let me get my drawing tool. When you analyze this, it looks mostly flat, right? Yep. And that probably has to do with the risk event coming out in 2 hours, huh? Yep. Well, that's exactly right. That's what's going on here. Yeah, my drawing tool never showed up. Let me try it again. Epi. Where's my Epi pen? Open. Oh, yeah, I forgot when you reboot the machine, it loads the app 3 times for some reason. Hang on. Where's my Epi pen? There it is. Yeah, 3. And now let's bring it back. There it is. That nice little upgraded feature of theirs. When you reboot, load the app 3 times. All right. So, anyways, that's not just the zero line. Doesn't that look like the current trend? What is that? Niet. Nothing's happening except these outliers, right? NASDAQ, DAX, S&P 500. What does it show you? Risk off, huh? Risk off, risk off, risk off, risk off. Now, this is some risk on, but everything else is flat, right? Everything else is flat. So be careful right now. Be careful right now. The market clearly is waiting because remember, this is nearly real time. The market is waiting for that event, CPI, and the volatility is going to kick up. So we got to be careful. We probably don't need to go back to 1914 for inflation data. Well, anyways, so there it is. There's where the normal levels of inflation. Going back to 2009, you can see 2008 we came down, and then back to sort of normal levels, part around this 2%. And holy smokes, an explosion of inflation around the world. The UK, they win. They got to 11%. 8% in the US, 7% in Canada, 11% in Euro. Some of these numbers not printing properly, but nonetheless, you can see the spreads of these levels of inflation. Just incredible spreads, meaning some economies were impacted more than others. Zoom in a little closer. And the thing is, like, where are we going to be in the near future, I suppose, right? So here we have a trend, don't we? Headline inflation 3.2 previous, 3.4 now, 3.8 expected today, the new print. Notice that's headline, and headline inflation is going up. Now, why do we care about CPI today? Because we care about what is going to happen 1 week from now is the FOMC meeting. So let's do some translation here. Clearly, there's an uptrend going on. What's creating this? Commodities. Everybody knows it. It's just commodities. And the Fed can't do anything about that. Oil's up. Okay. Does that have anything to do with interest rates? Nope. Does supply or demand of energy have anything to do with the Fed? Nope. So the Fed couldn't care less. So they get rid of it. And we look at core. So what you want to look for today is core. So the trend right now in the United States is headline inflation is going to be up today. It's going to be higher significantly higher. Okay. However, when you look at core will be lower. I'm going from memory. Where's core right now? 4.7. So I think we're going to do like a 4.4. If it comes up 4.2, holy smokes, the market's really going to take off. Now, what's the logic of core? The lower the core is, the less the Fed needs to do in the future, which means maybe not even a rate hike in November. Now, I expect one in November. I said 9 months ago that September wouldn't be a month they raise. So I think because what they need to do is everyone cares about the September meeting. Don't get me wrong. Everyone cares. All the kids are sitting at the table. Okay. And the Fed's going to say to them, one more while everyone's listening. They can't do it in the summer. Well, because nobody's around. So now that everyone's here, they're going to say, not this time, but one more. Right? That's sort of the expectation. One more this year. And then we're done, kind of thing. One more and we're done. That's kind of it. Now, if core inflation is like 4.2, there could be an argument that the Fed is done now. Now we won't know for a week, but people are going to make that trade. So we'll probably want to look at the Fed Watch tool. Now it's probably not going to come out 4.2, 4.1. That would be very dramatically lower. So expect like 4.3, 4.4. And at that point, what'll happen is just what everybody thinks is going to happen. September, no hike. The meeting after that, hike. Meeting after that, no hike. And then all of 2024, interest rates are the same. Now, then the next piece of news that we will be watching at the end, between now and the end of the year, will be, will there be cuts in 2024? Right now, and we have this is, where's the central bank stuff? We have this as fact. We already know this. So this is the next argument. So I gave you the first argument, core CPI numbers leading to the next Fed meeting. Okay. Let's go here. So we have one more. Okay, it's already a fact. We have one more rate hike in the United States, and then in the third quarter of next year they cut. So we need to confirm there's only one more rate hike. That's what today's CPI is going to lead people to believe. And then 1 week from now, we get a new summary of economic projections. And what we want to watch for is, will this go up? Will this go up? From 2 cuts next year to maybe only 1 cut to maybe no cuts. Ooh la la. That difference would need to be priced in. And Quant-in-a-Box gives you the facts. So instead of having download the summary of economic projections and then go through the dot plots, well, just why don't you have Quant-in-a-Box automate that for you and put it in nice, pretty colors? Yeah, good idea. Yeah, good. Oh, yeah, we did that. Sweet. Very cool. If you want to look at inflation, since we got inflation number. Okay. Again, headline. Boop, boop. So where are we? Third to fourth quarter. We're kind of in this 4.3 to 3.6. The thing is, we actually know that this is going to start slightly heading up. Now, again, these are the projections from the Fed. These are not actuals. This is what the Fed has forecasted. So anything less than 4.3, is desirable, but we know it's starting to flatten out already on the headline number. Interesting, huh? Okay, so this is the process that we're in here. Bup, 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 bup. Okay. And then if you wonder, like, what do you mean 4.27? How can you do that? What do you mean 2.8? What do you need? What do you mean 5.4? These are averages in the dot plot. Remember, there's something like 16 dots that have to be averaged out. So that's why you get these, what do you mean interest rates in the United States are expected to be 5.18? Well, why don't you round it to five and a quarter from five and a half? Yep. So anyway, so that's that. And the other thing I'm interested in is well, like gold and oil today could be interesting. So you might want to watch the yield on the 10-year. Technically, this is going up. Uh, Hopefully, these yields start coming down. Now, yields will come down if people expect the Fed is done or nearly done. Nobody cares if the Fed raises one more time. What we care about is what does the summary of economic projections say next week? And is there going to be cuts next year or not? That's what we care about. So once we figure out when the top is hit, um, this drop in the bond market, and you're like, what do you mean drop in the bond market? This is yields. So if yields are going up, the bond market's falling. At some point, when we figure the Fed is done, people want to buy as low as possible. They're going to buy and hold, buy and hold. And what we'll see if they start buying is these yields will fall. So imagine if you bought them today. Well, it'd be risky to do that today because we don't know core CPI. That's why today is important. And core CPI only tells us what's going to happen or helps us predict what's going to happen at the FOMC meeting and the summary of economic projection. So 1 week from now, we'll have all that data. Well, why don't you wait? Do you have to be the first one into buying treasuries at a low? I would argue no. So I think if you're an institutional treasury investor, you could wait to the SEP. You could wait for Quant-in-a-Box an update. And then what if these drop all the way to 4.13? Well, then you could lock that in for 10 years and have income higher than inflation. Double the rate of inflation. Eventually, we'll get back close to 2.0, right? Is the theory, anyways. Cool. So that it's going to get, I think it's going to get exciting for somebody at some point soon. uh, my concern is it goes even higher. That's my concern. Like that core starts going up and then, but very unlikely, but it's plausible. Now, the other thing with gold, if the number is low enough, today's CPI number, core CPI, if it is low, again, 4.2, wow, that would be a great improvement. The US dollar would weaken, I think. And that would push the stock market up too, and Bitcoin, and a bunch of other things, just aggregate demand. But there's this other flip side. What if inflation is high? What if it doesn't fall? Then maybe gold goes up. So I don't know. I'm long gold. I know you can see seasonally, it's probably not the greatest idea, but I'm long and I'm at break even. And who knows how today goes? Institutional investors are long, retail investors are long, dogs are living with cats. It's weird. Okay. So everybody's long and somebody's wrong. And I fear it's all of us bulls, but we'll see. I'm just trying to hang on. My plan was get in at a good price, jam my stop. And because I don't know how this quarter goes, what if I'm wrong? Because I want to be long in the stock market. Well, what if I'm wrong in the stock market and gold happens to go up for whatever reason? Well, at least I got that. So it's some weird form of hedge. It's just like it was a good buying price. It was a good setup. I took it and it's now modestly profitable from reasonably profitable, but I can't lose money. So I'm not going to get out. Who knows? Maybe I get lucky. We'll take a look at the risk gauges. Everybody's neutral. Remember how this was like -5, and then -4, then -3, then -2. Now it's -1 on a weekly basis. Mhm. And this is flattening out quite quickly, where like hardly anything's happened in the S&P 500. Hardly anything has happened on with the yen. Hardly anything's happened with gold. Hardly anything's happened with the 10-year T note. Okay, the yield is up, so price is down. Yeah, it's negative. Yeah, oh yeah, yeah. Dixie is up, which is bad, but over a month, that's not crazy. Over a week, it's flat. Okay. And VIX down. VIX is good. I'm looking for a rally to appear after today and maybe after FOMC. And I do have a strategy in mind for low volatility, in particular, a play on the VIX. Cool. So falling VIX is good, but not good enough. So zeros, lots of zeros right now. The market is going neutral. So reminder, 10 days ago, bearish, bearish, bearish. Or I should say risk off, risk off, risk off. Then it was risk off, risk off. And now it's just a cat's whisker into risk off. I mean, it's flat. Might as well just call it flat. Okay. So could it be CPI? Could it be FOMC? Uh-huh. Yeah. So commodity currencies, maybe? What if things come out and core CPI is low, not crazy low. It comes out 4.3. It doesn't make the world risk off, doesn't make the world risk on. It's just not risk off. Okay, as expected. So nothing moves that much. But we're staring at core because we're worried about things like commodities. Okay. Everything is down, right? Technically, definitely down. Down, 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 down. Okay. Then what? Well, despite all of that, somewhere around the September October period, which is kind of like what, the third week of September, this asset tends to turn north. Like every year almost, huh? Look at the 20-year average and the 5-year average. I wonder if that happens like soon. That'd be something to consider. I don't know. The big thing would be the US dollar weakens because the US economy is improving and will likely not go into a deep recession, at least not this year. And then I don't know, Aussie, maybe Aussie doesn't change at all. But I've looked at the exports of Australia and they're low, man. They're low. But are they so low that they can't get any lower? Is it so bad? Is it Aussie dollars so cheap that maybe it doesn't fall any further? I don't know about that. But nonetheless, you got to keep an eye on this moving that way. For example, Australia is supposed to be an exporter of commodities to foreigners. That's what they do. That's the business of the company we call Australia. Yeah, countries can be companies. That's what they do. Commodities Incorporated. The problem is they've imported last month more than they exported. They actually had, instead of a surplus, they had a deficit. Australia is not supposed to have a deficit. So there's a reason why this is a dog with fleas. But maybe things improve? Question mark. I say it like with a big question mark. Maybe things improve? Right? I don't know. So you got to pay attention to that. Okay. But nonetheless, maybe just dollar weakens. Well, what about like a USD kitty cat? Maybe Canada benefits faster. Now, this is very bullish, which is the same as Aussie dollar being very bearish because of the numerator and denominator swap for the USD. But nonetheless, you see how Canadian dollar tends to get stronger than the US dollar somewhere around the September October period. Dare I say, third week of September? So we're right in that window. Maybe it has to do with today's CPI. Maybe it has to do with next week's Fed meeting. Uh huh. Yeah, maybe, huh? And pachow, maybe just out of the blue, Canadian dollar gets strong. Or maybe just out of the blue, US dollar gets weak. And ideally, both at the same time. Okay. And maybe this starts to, right? Starts a new direction. I don't know. But it's something to be paying attention to today. Particular, when oil is going up, let's go back to commodities, right? Retail is heavily short oil. Ooh, this is just moving tickety boo. Okay. Typically flat to down. Typically flat down. I don't know if oil prices get so high they can't go any higher. I don't know if there's any logic to that. So, anyways, I think that's good enough for today. I believe you understand what we need to be looking for in today's CPI number. It's known that headline number is going to be high. What we care about is the core number to be lower because the Fed can't do anything about high commodity prices. They can try to work on inflation like wages, and they can try to work on inflation like rent. Those are the two sticky things. And how do you do that? Well, you keep interest rates high and people stop using their credit cards. They stop borrowing, they stop wasting money. Things get too expensive to do silly things like look beautiful on Instagram all day. So it changes people's behavior. That's what the Fed's trying to do. And that, by the way, is the study of economics. What do you do if money gets expensive? Well, you start changing your behavior with spending. Instead of going to an international vacation next year, you go on a domestic vacation. Instead of eating filet mignon, you start eating, I don't know what a top round steak is, but how about like chicken, right? And stuff like that. You start changing your behavior. Okay. Maybe you drive a Ford F 150 that uses gasoline instead of battery power. Okay. Right. And you start changing your behavior. And in this case, companies might stop paying higher wages because they have enough employees, because consumer demand for their products and services is falling. So they don't need so many workers, and they certainly don't have to overpay for mediocre workers. So they start changing their behavior. Maybe wages stop going up. And then if those workers can't afford or lose their jobs and need to move away, then rents start coming down. And it's likely those things will happen, but rents take a while, and we call it sticky. And wages. When will you accept a lower salary? When it's the best salary you can get. And those things are also sticky. So we're not quite there yet, but the Fed is watching them. But if you do deeper dives into this kind of research, um, things should be improving. Things should be improving. And so now we know to look at the core to see where we are now. And also, you should use the Fed Watch tool to discern if institutional investors believe those cuts are coming. Oh, so let me just do that, I guess, before we wrap up. Um, why not? Huh? Let's do it now, right? There's no better time than right now. What we're trying to do, and then let me bring Quant-in-a-Box back. Bring it back to me. Here we go. Here's what we're trying to do. Let's go back to central banks. I hope you don't mind going a little long. Um, what we're trying to do is look at what the market believes these dots are going to do in next week's summary of economic projections released by the Federal Reserve Board of Governors. Will these dots go up or down? I mean, honestly, this is what today is about. 99.5% of market participants don't get this, but they don't trade billions of dollars. So the ones that trade billions of dollars do. So, anyways, institutional traders are questioning this. So when CPI comes out, we're thinking, what about the third quarter, or the end of next year? Not this year, next year. So you look at this, and then you go the end of next year, and we want to see the cuts. And cuts are being priced in and priced out, priced in and priced out, priced in, priced out. And we're trying to see which way these go. So here's those interest rates at that time. So lots of rate cuts are priced in because, partially because, I mean, those are opinions. Those are actual contracts negotiated. So they're not opinions like, what do you think? It's more like, what are you going to pay? Like, these are, to get this data, it's real money being negotiated in contract. Then you can derive from price. Let me do a quickie for those that are new to this. Here's the price of these bonds. So you can lend the government. This is actually bank to bank. So bank to bank lending, and you can lend somebody $95.30. And at the end of the term, they will pay you back $100. There's no interest rate. There's only a price. Interesting, right? I'll lend you $95 today. You pay me back 100. So what's the interest rate? Well, you have to reverse engineer it, and that's how you derive this. And so this is an aggregate of banks lending banks money, and you can derive from an average price what they've negotiated. Okay. All right, cool. So, anyways, so they're pricing in a cut or not. This is actually where the term pricing in comes from. If you've ever wondered, it's this. What are the banks pricing in for the future? So, we want to see if these are shifting left, which means more cuts, or shifting right, which means less cuts. And this is likely to change today after CPI, in particular core CPI, and people are going to go, oh my God. Let me expand this out. They're going to go, oh my God, this dot is going to go up next week. And that's what that is all about. But we still don't know because the FOMC gets together Tuesday of next week. I think that's the day they do the dot plot. And actually, you know what? No, it's not. It's Wednesday of next week. And it's a private little survey that the Fed people do on their own. And then they release that. So anyway, so 1 week from now, Fed members, FOMC members are going to vote, not vote, but complete an internal survey of where they think interest rates are going to be in the future. And these may go up. And if so, the dollar might get strong because they've priced in, these guys have priced in a cut. Here it is. That's the dot plot falling. But if things change and you're like, oh my God, the Fed's not going to cut next year, then things are going to move this way from 4.75 to 5 to 5 to 5.25. Okay. And the money starts shifting this way, which is predicting the dot plot goes up, which makes the dollar get strong. Cool, right? It all depends on the value of money. And that's what we're trying to figure out as astute intellectual investors. So I hope that puts today's news in context. Today's news puts next week's news in context. And next week's news puts the third quarter of next year into context. And that's what matters. And everybody else, what do? Oh my God, look, CPI 3.6. And they react to that. You're like, dude, you don't even know what you're doing. It's so strange how the market freaks out on Ether. Not Ethereum, but just nothing. Nothing. Okay, nothing. So you have to put everything into context. So I hope this helps. Peace on earth. May the pips be with you. May your profits be above average. Cheerio.